If the world's debt were suddenly paid off, the global money supply would collapse with it. Every country on Earth is in debt. The United States owes $38 trillion. Japan owes $9 trillion. The entire planet owes $315 trillion, 3 times the size of the global economy. That means the dollars in your bank account exist because the debt does. That debt is not theoretical. It is compounding right now, and interest accrues every second. Now consider the paradox no one resolves. If everyone owes money, who exactly is owed? Follow the chain of creditors. Track who actually holds the debt, and the answer removes a comforting assumption. The world does not owe money to a distant empire or a single throne. It owes money to itself. And once the obligation loops inward, there is no external balance sheet waiting to absorb it, and no outside authority waiting to clear it. 4 men across 3 centuries understood that before anyone else acted on it. They did not meet, they did not coordinate, yet each one redesigned a piece of the structure so that debt would never be extinguished, only extended. They built a system where governments borrow forever, where interest flows upward without interruption, and where every crisis becomes a reason to reinforce the structure rather than dismantle it. That means each crisis stops being a chance to reset and becomes a reason to recommit. And after that recommitment, the system can only move forward by adding more obligations onto the same frame. The meetings happened. The contracts exist. The mechanisms are recorded. And once you see how the machine was assembled, $38 trillion stops looking like a mistake and starts looking like the mechanism functioning as intended. Let me take you to the first decision that changed everything. Before 1694, kings borrowed the old way. They went to merchants or nobles, promised repayment with interest, and if they failed to pay, they defaulted. Creditors absorbed losses. Kings found new lenders. It was unstable and embarrassing, but it was finite. Debt was temporary, either settled or written off, and when it broke, the system reset. William Paterson saw the instability and chose a different path. He had tried and failed at other ventures, and by 1691 he was looking at a government cornered by war. England was fighting France. King William III needed money desperately. The treasury was empty. Tax revenue could not cover the cost of war, and traditional lenders were refusing fresh loans because England had defaulted before. The king's options were shrinking, and with each refusal, the window for a normal loan closed further, because delay meant losing the war funding before it could even be negotiated. Paterson approached him with a proposal that removed default from the equation entirely. He would organize wealthy merchants to lend the government £1.2 million, an enormous sum. But the principal would never be repaid. Instead, the government would pay 8% interest every year, indefinitely. The moment the principal stopped being repayable, the government lost the exit that made borrowing temporary. And the only remaining path became ongoing servicing financed by whatever taxes could be extracted. To manage this, Paterson proposed a new institution, the Bank of England. Parliament approved the scheme in 1694. The merchants delivered their gold, and the bank lent it to the government. The government began paying £96,000 a year in interest, funded by taxes, and that obligation did not come with a maturity date. It came with permanence. Once permanence replaced maturity, repayment stopped being a future decision and became impossible in practice. Because the system no longer contained a scheduled point where the debt could clear. The merchants received banknotes they could trade, instruments backed by Parliament's promise to tax its citizens forever. The door of repayment closed. In its place stood perpetual servicing. And with that closure, the government's only way to keep the structure intact was to keep the interest stream uninterrupted, regardless of other priorities. Then Paterson added the feature that made the structure self-expanding. The Bank of England received the right to issue notes backed by government debt. The government's IOU became currency. The more the government borrowed, the more money could be created. Once money creation depended on borrowing, the system could no longer treat paying down principal as a neutral improvement without shrinking the base the notes rested on. Debt was no longer a temporary burden to be cleared. It was the base layer of the monetary system. Within decades, the model spread. France formalized national debt issuance. The Netherlands refined its structures. By 1790, the United States adopted the same framework under Alexander Hamilton. Permanent debt, interest paid from taxes, bonds circulating as assets. As bonds circulated, the ability to treat debt as a contained contract weakened, because the claim could move while the obligation remained fixed. The pattern hardened. British government debt was never eliminated. It was refinanced, rolled over, enlarged. Once refinancing became the routine, the slate never approached zero again, and the option of a clean payoff stopped being part of the operating playbook. The option of clearing the slate quietly disappeared from serious discussion. By the early 1800s, European governments had accepted debt as routine, but the market around it was fragmented. Loans were negotiated one by one. Participation was limited. That left space for Nathan Rothschild to make a decision that would close another exit. Because fragmentation still left room for refusal and isolated defaults that could be contained, the Rothschild family had built a network across London, Paris, Frankfurt, Vienna, and Naples. They could move money across borders faster than governments could move information. During the Napoleonic Wars, Nathan did not simply lend to Britain. He bought bonds at a discount and resold them to investors at a markup, creating a secondary market that industrialized sovereign debt. Once a secondary market existed, governments no longer negotiated with one lender at a time. They depended on continuous distribution, and once they depended on distribution, they could not afford to break the instrument without breaking their access to funding. Governments gained immediate funding. Investors gained tradable securities. Rothschild captured the spread. Then came 1815 and Waterloo. Nathan learned of Napoleon's defeat before official channels in London. He sold British bonds, signaling loss. Prices fell. Others followed. When panic drove prices down, he bought in size. When victory became public, prices surged. After that sequence, markets stopped being a place where price reflected only public events and became a place where timing and information could move price first. Meaning governments were now exposed to funding conditions they could not control. He had demonstrated that controlling information and distribution meant controlling the market itself. This innovation changed the consequences of default. Bonds were no longer held by a single lender. They were owned across borders, passed from one institution to another, used as collateral for further loans. A British bond could sit in a French portfolio, then in a German bank, then underpin credit elsewhere. Once bonds became collateral in other balance sheets, default stopped being an isolated refusal and became a trigger that would force liquidations elsewhere. Making the act of not paying immediately remove other countries' financial room. Default no longer harmed one creditor, it threatened an interconnected web. Governments did not keep paying because they were virtuous. They kept paying because default now meant systemic collapse. Once collapse became the consequence, refusal stopped being a bargaining tool and became a non-option. The cost of refusal became existential. By the mid-1800s, the Rothschilds were the wealthiest family in Europe, their fortunes tied to interest on sovereign debt. Patterson had made debt permanent. Rothschild made it interdependent. Once interdependence set in, a government could no longer exit alone without dragging others into the same failure. And that meant even governments that wanted out were forced back into servicing to avoid triggering chain reactions. The trap tightened. By 1900, the United States was rising economically, but still lacked a central mechanism to manage crises. Banks were independent. Money supply was tied to gold. There was no guaranteed buyer of government debt. That limit mattered, because without a guaranteed buyer, borrowing still had a ceiling imposed by available capital. In 1907, panic hit. Stock prices collapsed. Banks failed. The economy froze. J.P. Morgan gathered the major bankers in his library, locked the doors, and forced them to pledge capital to stabilize the system. The panic eased, but Morgan understood the vulnerability. A rescue that depends on one man and voluntary pledges cannot be repeated on command. And once that was clear, the system could not rely on improvisation the next time pressure returned. He could not personally rescue markets forever, so he and his associates chose permanence. They needed a central bank. But Americans distrusted that idea. In 1910, representatives of the largest banks and Senator Nelson Aldrich met in secret on Jekyll Island. For 9 days, they designed what would become the Federal Reserve. The secrecy was deliberate. Public knowledge would have destroyed the plan. And that meant it had to be built in a form that could survive scrutiny later, without being reversible through popular rejection. The structure was political camouflage. It would not be called a central bank. It would appear decentralized, with 12 regional institutions. It would be overseen by a board appointed by the president. But the regional banks were owned by member banks. Those banks elected the regional boards. The most powerful branch, the Federal Reserve Bank of New York, was effectively controlled by the largest Wall Street institutions. Once ownership and election rights were embedded in the structure, control could not be separated from the system without dismantling the system itself. The power to create money and purchase government bonds would sit there. The Federal Reserve Act passed in 1913. With it, a limit dissolved. Before the Fed, government borrowing was constrained by available capital. After the Fed, the government could issue bonds and the central bank could create money to buy them. The bond became money. The money funded spending. The debt moved onto the Fed's balance sheet. Once borrowing could be met by created currency, the market's ability to force restraint weakened, and the government's dependence shifted from finding lenders to maintaining the machinery that would keep buying. Demand for government debt was no longer dependent on market appetite alone. It was institutionalized. That single mechanism removed a natural ceiling. The government could roll over debt indefinitely because there would always be a buyer capable of creating currency. Once rollover became the normal operating condition, the system could not return to a world where borrowing paused without forcing an immediate contraction in what that borrowing had been sustaining. The trap shifted from permanent to potentially infinite. By the 1970s, this structure operated globally. Developed nations borrowed and rolled over debt routinely. Developing nations borrowed heavily for infrastructure, often in dollars. As long as rates stayed low, payments were manageable. The moment manageability depended on low rates, those borrowers lost control of their future, because the cost of servicing would now move with decisions made elsewhere. That assumption ended in 1979. Paul Volcker faced double-digit inflation and a weakening dollar. He raised interest rates from 11% to 20%. Inflation slowed, but the move detonated another fuse. Developing nations that had borrowed at low rates suddenly faced tripled interest costs. Mexico, Brazil, Argentina found themselves unable to service their debts. In August 1982, Mexico announced it could not make payments. Once non-payment was stated openly, the system reached a fork where someone had to absorb losses because the interest streams could not continue without new funding. Default should have reset the system. American banks held much of that exposure, losses would have been severe, some institutions might have failed. Volcker had a choice: allow the market to clear or prevent the collapse. He chose prevention, and in choosing prevention, he removed the clearing mechanism that would have reduced debts through write-downs. Through the International Monetary Fund, loans were arranged to keep interest payments flowing. These structural adjustment loans came with conditions: spending cuts, privatizations, market openings, currency devaluations. Sovereignty traded for liquidity. Once the bailout route replaced write-downs, the system could no longer use failure to reduce leverage. It could only use failure to renegotiate terms while keeping payments alive. The new loans did not eliminate debt, they refinanced it. They extended maturities. They locked countries into long-term servicing arrangements. The option of default was replaced with managed dependence. And once dependence replaced default, exiting required confronting not one creditor, but the entire apparatus that now stood between the country and its payment schedule. This approach became precedent. When Greece faltered in 2010, when Argentina restructured, when Sri Lanka collapsed, the pattern repeated. Emergency loans, austerity, restructuring. Debt was not forgiven, it was reorganized. Once reorganization became standard, unpayable debt stopped being allowed to end, meaning the moment of failure no longer cleared the obligation and instead converted it into a longer chain. The trap became global policy. Now step back and see the composite structure. Patterson made debt permanent. Rothschild made it globally tradable and systemically entangled. Morgan's framework made it expandable without clear limit. Volcker's intervention ensured that even when debts became unpayable, default would be suppressed in favor of restructuring. Each decision removed an exit, and each removed exit forced the next response to happen inside narrower boundaries, because the system could no longer tolerate the old release valves. The result stands before you: 315 trillion in global debt. Government, corporate, household, none designed to vanish. All designed to service interest. All interlinked so that failure in one node threatens the entire network. Once the network is built this way, stability stops meaning repayment and starts meaning continued servicing, because repayment would unwind too many connected claims at once. In the United States, 38 trillion in federal debt sits on balance sheets. Roughly 20 trillion is held by institutions and the Federal Reserve. Pension funds, mutual funds, insurance companies, banks hold treasury bonds as safe assets, collecting around $1 trillion a year in interest. That interest comes from taxes. Money flows from workers to government, then from government to bondholders. Once that flow becomes a funding line for major institutions, interrupting it stops being a fiscal option and becomes a systemic rupture those institutions are positioned to resist. The flow is continuous. Another portion is owed internally, to trust funds like Social Security and Medicare. The government borrowed from those programs. When they need redemption, taxes must rise or borrowing must increase. Once redemption depends on either higher taxes or new borrowing, the system cannot choose a painless path, because every route to pay creates a new constraint that tightens future budgets. Either way, servicing continues. The circle closes without shrinking. Globally, Japan's debt is held largely by domestic institutions and the Bank of Japan. Europe's debt is tied to its banks and central authorities. Countries hold each other's bonds. Through the IMF and World Bank, exposures cross continents. Everyone owes everyone, and institutions mediate the claims. Once mediation becomes necessary for routine functioning, direct settlement becomes less available, because the mediator's balance sheets are built around carrying claims forward rather than clearing them. Here is the constraint that locks the system. If the United States attempted to repay its $38 trillion in full, the money supply would contract sharply. Dollars are created through borrowing. Retiring the debt would erase the currency tied to it. Deflation would follow. Economic contraction would follow. Once repayment implies contraction, repayment stops being a policy lever and becomes a self-inflicted collapse that no institution can choose without destroying the environment it operates in. Policymakers understand this. Paying off the debt is not treated as a realistic path. If every government attempted to eliminate its obligations simultaneously, global liquidity would shrink dramatically. Trade would cease. Asset values would plunge. The design links debt to money so tightly that removing one destabilizes the other. Once global settlement implies global contraction, coordinated payoff becomes impossible, because the act of clearing would erase the medium that clearing requires. The option of full repayment is theoretical, not operational. The institutions holding this debt manage trillions. Asset managers buy government bonds using pension contributions, retirement accounts, insurance premiums. Interest payments flow steadily. From the perspective of the system's operators, rising debt expands the asset base. Once the asset base is built from the existence of debt, reducing debt becomes a direct reduction in the collateral and income streams those institutions depend on to maintain their own commitments. Servicing costs are labeled debt service, not tax, but the economic effect is identical: revenue transfers to bondholders. The four architects did not meet, yet their choices aligned: permanent debt, global interconnection, centralized money creation, managed restructuring instead of default. Together, they built a structure where governments borrow continually and service perpetually. Once perpetual servicing becomes the operating condition, no one actor can reverse it without triggering losses across the same interconnected holders the system has already empowered. From within that structure, $38 trillion is not an error to be corrected, it is an asset to be maintained. Every bond is someone's holding. Every interest payment reinforces the web. Once the web is reinforced through routine payment, breaking it stops being a corrective act and becomes a cascading impairment of balance sheets that were built assuming continuity. As long as confidence persists that interest will be paid, even if principal never is, the system continues. The debt trap is complete because the exits close onto each other. Repayment contracts the money supply. Default threatens systemic collapse. Restructuring extends obligations. Borrowing sustains liquidity. Once each exit imposes a larger cost than staying inside, continuation becomes the only survivable option, even for institutions that would prefer a reset. 4 decisions across 3 centuries narrowed the path until only continuation remained. And now every country operates inside that framework. Everyone participates. Everyone is connected. The system does not promise escape, it promises continuity. Once continuity is the requirement, every crisis response is forced to protect the chain of payments first, even when that protection narrows what can be done next. If this changes how you see government debt, if you recognize that $38 trillion is not an accident but a structural outcome, then you are seeing the machine as it stands. Debt is not treated as a temporary flaw, it is the foundation.